Yeah, like the Coldplay concert is a flex, angel investing is a flex.
Arjun Vaidya
is a DTC founder and investor
He built Dr. Vaidya's into India's largest online Ayurveda brand.
and led it to a successful acquisition of 100 crores.
He now runs a VC fund and is an active angel invested in over 130 companies.
There are lots of problems to solve in space. Everyone writing so many amazing things about Zomato, so many amazing things about Flipkart. This Flipkart, I know personally, had a lot of new tech movements. There have been a lot of companies that I've met in the last couple of months that I've said, you don't need money. You're doing really well. Do not take my money. My money will actually do.
Is there some sort of a profile of people that you think angel investing is for?
The worst thing you can do is, hey, you have great deals and great deal flow. Next time you're investing, just bring me along for the ride, right?
People do that?
A lot of time. I had someone who was working at a large company. He reached out to me and he said, how should I do this? And I said, this is the way you should do it. Exactly what I'm telling you right now. For the next 6 months, every week he sent me an update saying, these are the companies I've met. Would you like to meet any of these companies? Not saying, hey dude, where are you investing, right?
What do you think would be like the top 3 mistakes that angel investors typically make?
The first one would be allocating capital too fast. FOMO of renowned angel investor, renowned fund. And the third thing is, your angel investor is that person who can be the 11:30 p.m. panic call, as well as the person who can open doors for you by making
Great. So, Arjun, let's get straight to it. I think we all know what angel investing is all about, but it seems like the trend is really picking up now. Everyone sort of wants that little designation or that designation on their social media profile. Why is angel investing picking up so much?
Yeah, like the Coldplay concert is a flex, angel investing is a flex. Everybody wants to be associated with the cool new thing, and the cool new thing is startups. I think when I started angel investing, it was 2021. We still hadn't had the first season of Shark Tank. After the first season of Shark Tank, it's just gone like viral to want to angel invest, right? So I'll say that it's a exciting, cool new thing to do. It's great dinner table, like cocktail party conversation. I'll go a little bit deeper into say that it's a great identity also to create, right? So I was at Thai Global Summit in Hyderabad a couple of years ago, and I met someone who's from Rajkot at the summit, and he gave me his business card. He must be running like a 300-400 crore traditional tiles business. So in the front it had his company's name. At the back he had 4 companies' logos. On his business card he had 4 companies' logos, and he said, I run this company, it does well, I do lots of sales and some profit, but by the way, these are the 4 companies I've angel invested in. So I actually asked him, how much did you invest? He said 10 lakhs, 20 lakhs only, but it's identity, right? So 1, it's a flex, it's identity, it's good conversation. 2, after Shark Tank, everybody's understood it, and so everybody wants to be a part of it. And 3, I think, like, especially for someone who's not from the startup ecosystem, we'll talk about why startup folks do it, and that's a separate conversation. But for someone who's not from the startup ecosystem, who's running a traditional business, let's say a manufacturing business or an old school family business, the excitement in business goes away when you're growing 10, 20, 30% year on year, and you're doing the same thing over and over again, and it's not like you're opening something new, a new division, a new business. So I think for those people as well, it becomes very interesting to be a part of this thing. And I think whether or not a startup is successful, given my job is to meet these people every single day, it is very exciting, right? So like, let's say I don't invest in AI. Every company that I see in AI just blows my mind, right? And so just imagine someone who's running a traditional business, mind is blown every time they speak to their startup founders. So I think these are the few reasons why people are getting more and more excited and engaged with it. I think it's also been democratized over the last 5 or 6 years. So I remember a time when it was only accessible to a certain group of people. Only certain people could be angel investors. You have to be part of that network, part of that clique, etc. All of that. Very exclusive, which it's not now, right? So when people come to me and say, I want to angel invest, now you can democratically join an angel network. You can pay a 15,000-20,000 rupee annual fee and join and hear 50 pitch calls or 60 pitch calls. And so if I speak to any new person who's angel investing, I'm like, before you put a rupee, you can pay 20,000 rupees, join 60 pitch calls, and then decide whether it's for you or not. So I think that's another nuance of the last 5-6 years which didn't exist.
And that's something I want to get into as well, who it's for, who it's not for, and how can one do it. But let's talk about your role as an angel investor, because typically I'd understand it would be experience, which you have, the knowledge. Do you also facilitate, connections, bringing that to the table? What is your role as an angel investor typically?
So I think before I start about what I do with the companies, I think I talked about a certain type of angel investor who's not from the ecosystem who's investing. Then there's a bunch of us, a lot of us now who are from the ecosystem, who are founders, ex-founders, operators, who have seen some value creation from the startup ecosystem, right? So for me, at 29, I saw life-changing value creation when we exited our business. We felt at that point that we have seen this, we have seen value creation from it, both from a monetary as well as a life standpoint. So there is some part of this that we want to give back to the startup ecosystem. So my family as a family, or my wife and I, decided that like 10% of what we made from our exit, we'll put back into startups, and we'll do it in such a way that we invest only small checks. So we won't invest large checks in companies. We want this to be accessible to multiple entrepreneurs and work with multiple entrepreneurs. I think I have a portfolio which is largely consumer because that's what I know, but I have other types of companies as well. Specifically in the consumer companies, I like to take a quasi-active role, not completely active, but not passive, where, for example, just before this recording that we did, I met a company, a friend of mine who's running a company doing new age mukhwas. And
serious?
yeah, and doing very cool packaging, very cool products. And he was like, can you help me with Diwali gifting? Now I have another company that I've invested in 3 years ago that sells healthy laddus and healthy millet-based bhujia. And they do very well in Diwali gifting. So I just facilitated a connection between the two companies. Now the mukhwas company will send the samples to these guys, and hopefully they can do some Diwali gifting hampers together, right? So I think from helping them with rebrand, getting the right performance marketing agency, helping them redo their website, to helping them raise more money, in the consumer companies at least, I can definitely add some more value than I do with others. And I like to be accessible to make those connections as well. But I will say one thing that some founders get wrong, right? So I've had founders come to me and say, hey, I've been running this business. I do distribution of, let's say, snacks. I'm very good at offline. I'm very good at GT. You know D2C, you're great at D2C. I'll take some money from you, you run the D2C for me. That's not possible. Like, even if I tell you it's possible, and I made the mistake of telling founders it was possible when I had my first 3-4 companies. I'd say, I'll do a call with you weekly, I'll do a call with your team weekly, etc. All of that. That's not realistic, right? Because when you have a company, when you have a portfolio of 10, 15, 20, 30, 40 companies, plus you have a full-time day job, if you get a company dependent on you for a certain business function that's crucial for their functioning, and then you're not able to give it time, you are doing a disservice to the company, and the company is losing out as well. So your angel investor is that person who can be the 11:30 p.m. panic call, as well as the person who can open doors for you by making WhatsApp groups or making calls for you. But they are not running your business, and they are not actively getting involved in your business.
They are not hand-holding you at all.
They are hand-holding you, but they are not, they're hand-holding you in the right direction. They're not walking with you into that direction and holding your hand until your IPO or something. That's not happening, right?
Now, when we talk about even the idea of angel investing, maybe it's a FOMO factor for some of them.
Massive FOMO.
Yeah.
Massive FOMO.
And I mean, you sort of read about stuff like the kind of returns that were made on a Flipkart or an Ola, and you say, hey, I want to be a part of that, right? Do you think that has a big role to play as well?
So look, I come from a traditional like family business background. My startup was new for my family as well. And then obviously after selling the company, I wanted to do this VC thing. And before I did, my dad said, hey, hold on. I want you to speak to one of my friends who's been doing this for like 15, 20 years, because you're taking someone else's money now and you're investing it. And so I met this lady. She's been in the startup ecosystem for a very long time. And she told me one very interesting thing, right? She said, look, Arjun, I was running a seed fund back then. I missed investing in a very, very large e-commerce business that generated a very large outcome, right? That company was growing well, but there were lots of other companies that were kind of doing something similar or the same. After I missed this company, the worst thing I could do is invest in the next 3 because of FOMO of missing that company, right? And so I think that's a big learning I took, that like, and I missed a lot of investments, right? Like I openly say I miss Zepto. It came to me and I didn't do it.
And look at them.
But that doesn't mean that the next 3 quick commerce companies that come in front of me I invest in. But it is really hard.
Yeah, exactly. So I want to know from you a little bit more with your personal experience. Of course, there's hundreds of pitches all the time. Do you have that rule of thumb? Do you say that, oh, if this works, like this clicks for me, if it's the founders or is it the financials, or what is your rule of thumb, or what are the 2 or 3 things that you'll see in a company and say, this is definitely not for me?
See, at the early stage, I think it's a big bet on people,
Yeah.
right? The founder, the founders. Who is that person? Why will they fight through tough times? I think that's not talked about enough as well, right? Like every journey is, it's not a straight line.
Yeah.
It's like an ECG graph, right? And so even if you see in the press, everyone writing so many amazing things about Zomato, so many amazing things about Flipkart. These Flipkart, I know personally from my previous job as a private equity investor, they had a lot of near-death moments.
Yeah.
The company was almost on the brink of not working. So there's this amazing book on the top 10 OG startup founders of India called How I Almost Blew It.
Okay.
And each of them, Anupam Mittal, Kunal Shah, Binny Bansal, Sachin Bansal, they all talk about the moments where it almost went to zero, right? And so I think, who is the person? Why will they fight through those tough times? And what is their right to win? There are lots of problems to solve in space, but I'm not an aerospace engineer to solve those problems, right? So I think these 3 things are 50-60% of my decision.
Okay.
20% of the decision will be on market size. So
The opportunity.
I am, for example, gluten-free and sugar-free. But I will not invest in gluten-free, sugar-free snacks because I can tell you less than 1 million people eat like that in India. I don't have coffee. That doesn't mean I won't invest in a coffee business, right? So I think believing that the market size will grow 5-10 times, or the business has the ability to grow 5-10 times from the time of your investment is also important. And the last thing is what everyone talks about, which is business, economics, revenue, growth rate, bottom line profile, gross margin, repeat rates, etc. All that. So I would say 50% founder, 20% market size expansion possibility, and then 30% on what the business is, what the numbers look like at the early stage at least. What I will definitely not invest in is, there is an AI wave now. There is a person who doesn't have years of experience in AI and they say AI is hot, seems like lots of people are getting money in AI. I'm starting an AI company and I'll figure it out, right? Because these cycles in the startup world last 1-2 years and then they go away.
Yeah.
And when they go away, it's really bad.
Got it. Just to, sort of scratch that point further, they say that the risk of angel investing means that the first thing you need to consider is just how much you can afford to lose. Is that true? Is that the mindset that you go in with it?
Yeah, absolutely. I think the problem with this asset class is, and nobody tells you this when you start, it is pretty much illiquid for a very long time, right? So I'll say I've done maybe 130 investments. I've exited 4. The 4 I've exited were inside 2-year period. And so they were not like massive exits, right? Because the companies got sold. And so I may be sitting on 20x gains and 25x gains and 30x gains in some companies. But is that capital available to me tomorrow? No, it isn't, right? And so what I could do in some of my good companies, like there's a company that I've entered at, let's say, 5 rupees in value that I entered the company. Today the company is raising at 100 rupees. It's been only 3 years since my investment. I know the company is going to do really well, but because I've not seen liquidity, I may take out some money at 20x when actually the prudent decision would be take out the money at 40x or 60x. So if you are investing capital that you need, then you start taking liquidity at the wrong time sometimes, right? And so you have to put a smaller portion of your entire portfolio, which is what people say is like 5%, but I am from the startup ecosystem, maybe I'll put 10% of our family office capital into this ecosystem. And my dad and brother who are more traditional side think I'm crazy. But I feel like I have some unfair access. So you have to put capital that you don't need on a daily, weekly basis. I think thinking you'll lose it completely means you've done a very bad job. Like if you de-risk yourself or you adopt a portfolio approach, and that's something that's very important. I think the other thing that people miss is you get really excited, you deploy the capital really fast, and you deploy it in like 3 companies. Now, it may not be the founder's fault, but it just may not work out, right? Those companies. And so you end up losing all your capital. So what I heard from some veteran angel investors is, you have 100 rupees to invest, split between 20 companies. Don't do, even if you like someone, you can, instead of 5, you can put 6 or 7 or 8 in them. But definitively don't put 30 rupees out of your 100 into one company. that's very risky.
Let's talk about your journey. You sold off your company, that's Dr. Vaidya's, for about 100 crore rupees. And then you said you made that decision to allocate X amount to angel investing. Can you walk us through that allocation? How much is it?
Yeah, so I think first, like, I wasn't sure I was even into this, honestly. So I started giving time to founders. Like, it was the summer of 2021. I was completely free in life. Like, I had exited my company and I was not staying on for a long period of time. So after I left, I had a completely open calendar. And then you start thinking like, oh, I'll do all of those things that I always wanted to do, like take long vacations, like get fit, play sport. And after like 1-2 months, you're like, I can't be at the club playing squash at 11 a.m. on a work day. Like, it doesn't make sense, right? So then I started spending time with founders. From that, I realized that some of the conversations I'm having are adding value to their business. And then I had some capital, so I said, let me start allocating now some of this capital. So that's how it started. It's been about 3 years now that I've been angel investing. I would say 130 companies now. And roughly $1 million invested across these companies. So like a $10,000, $15,000 check average per company, which is like 7.5 to 10 lakh rupees. That's the average amount allocated per company. I did diversify just from consumers. I would say 60% of the portfolio may be having like a consumer bend, e-commerce, enabler to e-commerce, D2C brand, consumer brand. And the rest I've invested in like edtech, fintech, space tech, B2B SaaS. All of these spaces as well have some exposure, but most of it has some consumer bend because that's what I understand.
That's your forte.
Yeah.
Do angel investors typically follow what VCs do, just to understand?
It's both ways, right? So sometimes I actually went and met all the consumer VCs and I understood how they invest. And the reason I liked meeting the VCs as well was because they have a certain amount of rigor. See, as an angel, I can punt. If a friend is starting something, or I know the person for a really long time, or they have a great background and I kind of know them, I can put a 5 lakh rupee check or a 3 lakh rupee check or a 7 lakh rupee check and see what will happen here. A VC can't do that. They have to write a 25-page note. They have to explain why they're making the investment. They're taking third-party capital,
they need
not their
proof of
capital,
concept.
etc. All of that. So I learned lots from Source VC, Manu, a lot from Kaval from Fireside, Deepak from DSG, Arjun from Invest, who I now work with, I run the fund with them. All of these people gave a lot of insights on how to look at these companies 3 years later or 4 years later, right? Because for an angel, you're like, oh, I just got to get the company from 0 to 1. But if the company doesn't get from 1 to 10, then you don't really make anything, right? So it's not about the journey to get to 1 CR in sales or your first 100 customers, 1,000 customers. How do you think about it from there? How does the next set of investors think about it? Because unfortunately, the kind of business we are in, you got to raise 2 or 3 rounds at least to get the company to the scale that you need to get it to.
No, I just want to understand. So what do you think would be like the top 3 mistakes that angel investors typically make?
Yeah, I think the first one would be allocating capital too fast. When you have capital and it's sitting and it's unallocated, and I've done this as well. I'm guilty of doing this. When you have a bunch of capital and you need to allocate, you just get trigger happy, right? And I think now that I've made those mistakes and been trigger happy, you're like, oh, I want to do one company in the quick commerce enablement space. So company creating dark stores. I want to do one company, right? Okay, I built a thesis why I want to do this company. It makes sense. And then I meet a company 2 weeks later. I just invest in that company. And then 6 months, in the next 6 months, I meet 3 other companies and I'm like, oh God, I could have invested in those companies as well, right? So I think allocating capital too fast.
Too quick.
I think FOMO of following renowned angel investor, renowned fund. Like let's say, for example, you get access to a deal that a top tier VC fund is doing. You don't know why they're doing that deal. And this is the only deal out of the 10 they did this year that you're getting access to. Instead of getting excited about, hey, I can invest with them, think, why are you getting access to only 1 out of their 10 deals? Maybe they have to do it, maybe they have to follow on, maybe they missed a company that's in a similar space that their competitor has done. You don't know, right? So following without knowing enough or building your own conviction, and I've done this as well, I made this mistake as well. And the company I did this with, eventually we got 50% of our money back. I didn't know anything about the space. I didn't know anything about why it was exciting. I just saw some really cool people investing and the background of the founder was
Jumped
cool. I didn't
on.
even speak to the founder, I just invested.
You got it.
That was 2021, that time was different. So I think crazy FOMO of following people just to follow people. And the third thing is riding a wave that's a wave in a momentary period of time, right? So today that thing could be AI, right? Tomorrow that thing could be consumer. Day after that thing could be food delivery.
Yeah.
The day after that, that thing could be quick commerce for anything else but what the quick commerce guys are doing, right? So just riding that wave because that wave is getting ridden. These waves come and go, and we are, as VCs, responsible for creation of these waves and creation of this FOMO. But you got to stay a little bit away.
If I may, just to understand where we're at right now in the startup ecosystem, do you think that there's been maybe a year of recalibration where now going from a seed series to a series B, which typically happened in say a year or a year and a half, is now taking longer? Is there more caution now with angel investing?
I think that there is definitely much more caution than there was in 2021 and some part of 22, and that was a crazy time. I remember someone on an angel investors WhatsApp group said, "Hey Arjun, you're an investor in this company. I heard they're raising money. Can you find out and find me a way to invest?" So I just messaged the founder. He said, "Hey, here's an RUV roll-up vehicle link where you can just commit anything above 3 lakh rupees." So I said, okay. And I was getting on a flight and I just forwarded that link to invest on that WhatsApp group where there were like 15, 20 people, something like that. I landed 2 hours later in Delhi and the founder calls me. He's like, "Dude, who did you send that to?" I said, "This guy reached out. He wanted it. I told you." He said, "We got 1.5 crores of commitments. You said you wanted one person to invest 5 lakhs. Who are these people investing?" And I actually had no clue who was investing, right? So that was a wild time where people were just deploying. I would get calls saying, desperately saying, "Can I buy your stake in this company?" I said, "I invested only 2 months back. What's going on?" I think that time's gone. So I think 23 was the year of correction, or 22 second half was the time of correction. I think it's corrected now. So startups are asking for more realistic valuations. Capital was a little bit more scarce. But I think we are on the way to going back to craziness, but people have learned from the caution, right? So lots of capital being deployed now in the seed to Series A stage.
Arjun, you've been doing this about 4 years now, like you said. Of course, you have that little bit of tilt to D2C. But other than that, which are some of the sectors long-term that you believe look pretty promising?
I think India to global corridor is a very exciting opportunity, whether it's in B2B SaaS or it's in consumer product export. I think in consumer products, the macro is that there's a lot of brand India being built. For the first time, there's positive association towards brand India, but there's aspiration for brand India. I think in consumer products, especially in categories like tea, yoga, Ayurveda, spices, those kind of food, there will be a lot of movement for Indian companies. I think in B2B SaaS or anything service related, there's still that cost arbitrage, right? We have smart, efficient people, and from purchasing power parity lens, because of our currency, I think there is value to be created there. AI, everybody's talking about it. I don't know enough about it to say, but I think obviously there's a lot of excitement towards that category and that space. And I think now what's happening more and more is that the mid-market private equity style investing is coming. So old school manufacturing businesses, old school distribution businesses, old school logistics businesses that have a healthy P&L, that have reasonable revenue growth, but great EBITDA profile, great PAT profile, are actually now attracting investment from early stage investors that said, "Nahi, ye traditional dhanda hai, is pe haath nahi lagana hai." That is changing now. So I think these 3-4 themes are coming out outside of consumer as well.
Now, for someone who is taking on the role of being an angel investor, not just to have it on their social media profile, but they want to take this seriously. Arjun, do you have a checklist of a few things you think that they need to do to scope out a company before putting the hard cash?
Allocate enough capital that you can do 10 to 15 investments. Then ensure that you have seen enough pitch calls and built a quasi portfolio, understood questions. Then build some relationships and some equations with people who are good in the industry. then be good to the founders so that they can refer you to other founders and then track your portfolio.
You said that you need to have an X amount of a corpus before you start investing. Say you've built that corpus, typically how much % would you advise putting in angel investing or in
Yeah,
stuff?
I would say less than 10% of your overall portfolio should go into alternative asset class. I say alternative asset class because some people don't want to do direct companies. They want to do investment into funds, venture debt funds, VC funds, PE funds, etc. But 10% allocation to alternative portfolio is the way I approach it.
And in your experience of having, you said 130 companies, etc., on average, what should someone expect as a return from this?
Could be anything. Could be 2x, 5x, 10x, 50x. I think you do this asset class to beat the benchmark significantly because of the risk, right? So let's say the benchmark has been delivering a lot now.
Yeah.
But let's say on average the Indian benchmark delivers 12%.
Yeah.
You should at least be getting 20% IRR from this asset class given the risk you're taking. And so in a 3 to 5 year period, you should aim for 5 times your money.
And what about is investing or angel investing tax friendly in India?
Yeah, I think there was a lot of regulatory issue with the angel tax, which was coming, not coming. I think in this last budget, the finance minister has abolished the angel tax completely. So I think from that perspective, it is conducive. It does attract capital gains in relation to unlisted equity as opposed to listed equity. So it is higher in terms of the capital gains, but I would say you have to wait for the capital gains to come and you have to wait for the return to be made. Once it's made, if you have made enough return, you're okay to pay the tax.
And where do you think we're at in India when it comes to the overall investment climate, startups? How much more would you compare it to the rest of the globe and say how much more ground we need to cover?
I think we are moving way faster than we were moving when I moved back to India in 2013. But I think that certain kinds of businesses that need really large amount of capital to get going, like a social media platform, like a new learning LLM model, etc., that which may need 10, 20, 30 million dollars to start. I think that level of risk appetite is still not there. We have risk appetite, we have people willing to invest, but those kind of things are not there. It may not be a bad thing. We may be more conservative as a country in investing. But I think some of those generational companies, like I saw a post from the founder of Kuku, who was building a Twitter-like or X-like platform. And he just said, look, we tried really hard, we raised some money, but this kind of business needs $50 million of capital before you see serious monetization. We got only 25 or 30. And we couldn't get any more, and so we had to shut down the company. So those kind of things may not be there because 1 in 20 of those will succeed, but 19 will fail. So that's one thing we don't have. Having said that, I think the amount of capital available in India is just immense and has never been so easily available, right? Like at the time we were raising money in 2017, 2018, we were like, get us someone to invest. Today, all my portfolio companies who are doing well are like, I have these 4 options, who should I choose? Right? So that says that if you're doing well, there is lots of options available to you.
And while you did touch upon this earlier, Arjun, let's just talk about, as an angel investor, what is the exit strategy? How does that work?
I think first you have to accept that the asset class is illiquid and will be for at least 4 to 5 years on each of your investments. If you're an angel investor, a lot of times the decision is not yours. You cannot decide when you want to exit. A further financing round or the sale of the company or the incoming investor will make that decision for you. And so keeping a strong relationship with the founder to be aware of these moments where you have liquidity options is crucial because they randomly come, right? And when they come, you have to be on the ball to be able to pick them up and take those opportunities. But liquidity is not easy, and so my advice would be whenever you get liquidity, at least take some capital off the table.
Arjun, any one thing that you believed that was true about the angel investment journey that you were proved wrong in?
I think it's not charity. Like the way people talk about it, they are like,
you're not giving a loan.
I want to help the ecosystem, I want to support people, I want to do all of this. And so there is a feeling developed among founders that like you'll get it if you just ask hard enough. But like that's not the case, right? Like we are allocating hard-earned money. And so yes, I'm doing it to support the ecosystem. Yes, I'm doing it to help entrepreneurs. Yes, I'm doing it so that more and more entrepreneurs get access to capital they didn't have, but it is not charity. And the rhetoric around it may look like charity, but I am not making any charitable donations to startups. I'm doing charity outside of my angel investments, but this is not my charity allocation of portfolio.
You expect a return.
There has to be. Like, you have to believe the company will generate. Whether it returns it or not is a different story. But you have to believe the company will make money for you.
Okay, Arjun, I think we've really got the A to Z when it comes to angel investing. So thank you so much for joining in.
Thank you, Avan, for having me.
Thanks for tuning in to this episode of Temperament. Would you consider angel investing? Comment below.
And always remember, for any personal finance decisions, including angel investing, it's always better to take advice from a qualified financial advisor. They can guide you according to your unique needs and goals to help ensure your financial well-being.
We'll catch you in the next episode.